You've probably heard the phrase, don't put all your eggs in one basket, right? Well, when it comes to investing, that's basically rule number one. So today I am going to break down what it means to have a diversified portfolio, aka how to invest smartly so you're not stressing every time the market moves. So let's get into it. First, what does diversification actually mean? It's simple. It means that you're spreading your money across different investments so that no one single stock, industry, or country can wreck your portfolio. If all your money is in one company and that company tanks, well, yikes, you are in for some bad luck. But if you're invested in different sectors and different asset types, you are way more protected. Think of it like this. You don't want your entire financial future tied to just one thing. For example, a Tesla stock, crypto, real estate. You want to have options so that if one thing drops, you also have other things that are balancing it out. And also realize that diversification isn't just about reducing your risk. It can also increase your chances of consistent returns. Some investments perform well at different times. So having a mix means you're able to have steady growth over time. For example, when bonds are down, typically stocks are up and vice versa. Let's talk about the 4 ways you can diversify your portfolio. Number 1, you can diversify by asset type. So stocks are great for long-term growth, but you don't want only stocks in your portfolio. So you can add things like bonds, like real estate, and even cash savings to help balance out some risk. Number 2, you can diversify by industry or sector. I know that personally I am partial to tech stocks because I've seen such great growth in tech stocks, but it's important that you don't just load up on one industry. Don't just load up on tech stocks because you love Apple or Tesla, because what happens when the tech sector has a very rough year? Instead, you should spread your investments across different industries like healthcare, finance, energy, so that way you are covered no matter what is happening in the economy, because it's very unlikely that all of them will be down at the same time. The 3rd way that you should diversify your portfolio is by geography. If you're only investing in the US or in Canadian stocks, you might be missing out on some growth. And this is because different economies perform differently at different times. So it's smart to invest globally. I know that, again, personally, I have some partiality to North American stocks and mostly US because the US is one of the strongest economies in the world. But I am realizing that it's important to have a bit of everything so that you do not have all your eggs in that one country's basket, especially with their leader right now. We don't know what he's about to do with the economy. So it's really important that you diversify globally. A great way to do this would be through ETFs that hold international stocks. For example, you can have VEQT, which has global stocks, or VWO, which has just emerging markets. So those are 2 examples of stocks that you can consider researching. The 4th way to diversify is by market capitalization. I find that a lot of people only invest in big companies. For example, the large cap stocks like Apple, Amazon, Microsoft. I am guilty of this as well. But if you want true diversity in your portfolio, adding some mid cap and small cap stocks can be a game changer. The smaller companies might be a bit riskier, but they also have a higher growth potential. If you truly want to have a well-diversified portfolio, you will have a mix of all 3 of them. Now I just want to get into the biggest mistakes that people make when they're trying to diversify. Number 1 mistake would be thinking that you are diversified when you are not. So if you own 5 different tech stocks, like let's say you own Apple, you own Microsoft, you own, what's another tech stock? Nvidia, you own, let's say you own 5 different tech stocks. Owning 5 different tech stocks is not diversification. Even though they are different companies, typically because they are in the same industry, they're all going to move in the same direction, right? The next mistake that I see is over diversification. So yes, there is such thing as having too many different stocks or too many different holdings. If you are somebody who has 100 different stocks in your portfolio, or 50 different stocks, or even 30 different stocks in your portfolio outside of ETFs, you're basically mirroring the market and your returns likely won't be as strong. So it's important that instead you choose a few stocks from each industry or just invest in an ETF. The last mistake that I see people often make is that they ignore correlation. Some assets actually move together, for example, airline stocks and oil prices. So if all your investments are correlated, that means that you are not as diversified as you think. Diversification is all about balance. You want enough investments to spread risk out, but again, you don't want so many that you're all over the place. So that is it. Now you know what it means to have a properly diversified portfolio. And if you are someone who's serious about building wealth for the long term, this is the key. Let me know in the comments, how diversified is your portfolio right now? I know that when I first learned about diversification, I realized my portfolio was not diversified at all, so I had to make some quick changes. So let me know in the comments, how diversified is your portfolio right now, and what changes will you be making to your portfolio? And don't forget to like this video, subscribe to my channel, and share this with a friend who needs to hear it. I'll see you in the next video. Bye.